Good morning, good morning, good morning, everyone. You're in the room right now. You're in the P.I.L.L Method Club. And I am so excited today about this particular show. Listen, we've got so much content today, so much content. I guarantee you we will not get done today. We're going to go over the best way to set up a mortgage. What are the best mortgage terms? What have we been taught on how to get a mortgage and how to manipulate that thing? Because there's so many choices. I mean, there's so many things to do. We're going to be going over whether a 15-year or a 30-year is going to be the best thing to do. We're going to be talking about consolidation. We're going to be talking about where are you getting your loan education. We're going to be talking about interest rates versus interest cost. We're going to be talking about the truth about bi-weekly payments. If you ever wondered about any of this, these two shows, today, Wednesday, and again on Friday for part 2, is you're going to learn so much about mortgages that, well, let me tell you why. Why do we need to go over this? Why is it important? I'll tell you why. Because this whole thing really got started. I mean, really started pushing forward in 1934. All right, right after the stock market crash and the Great Depression, right around that era is when amortization of 30-year mortgages came into being. And from that point on, we have been amortizing loans ever since. But most people have never received a class on how it actually works. So when we're setting up our mortgage, we're setting it up with information that is actually playing into the hands of banks. We think we're getting good information when in fact we're not saving money, it's costing us money. And we're going to be going over that. And let me start with this. The reason why I know what I know about this isn't because someone sat me down and taught me. It isn't because I just went out and said, let me figure this thing out. Let me sit down. Let me do a bunch of study. Let me see if I can figure out how lending actually works. I didn't do that either. So how do I know what I know? It is because I have Asperger's. I'm autistic. And when I look at an amortization schedule, when I look at how a loan is set up, what the bank gives us, the schedule that we make our payments, I see patterns in there that most people don't see. And when I see the patterns, and then when I see all the information we receive to set up a loan, it goes against the real pattern that's there. What the pattern that we're given, we do not have to accept. The information we're given, we do not have to accept. We can do things differently. And when we do, when we understand it, we can save so much money. If you have a question about this, come up to the stage. Listen, we're going to be putting some things on the screen as well. If you want to see this, see the examples, then pick up a secondary device like a tablet or a laptop, and then go to Twitter, Facebook, LinkedIn, or even YouTube. All right. And then search P.I.L.L Method, and you'll see our live broadcast that's up right now. So you'll be able to see what we're talking about. And if you have a question at all, at any time during this process, raise your hand, come to the stage here on Clubhouse, and you'll be able to ask your question about the lending industry and how it is that they're making so much money. You know, the lending industry is a massive rental program. You know, right now, there are people out there that says, why rent when you can own? Well, that's not true. because 90% of the people 90% of the people that you know with a mortgage will never own their home free and clear. So it is not why rent when you can own, it's why rent when you can buy. Most of us are home buyers, not home owners. You're not a home owner until the loan is paid off. Okay? When you pay off the loan, that's when you're a homeowner. Yeah, but most of us will never get there. We're home buyers. What are we going to do about that? So what I'm saying is that it's still a massive rental program is because the money we use to buy the home, we borrow from someone else. We're actually renting their money. Rent on their money is what most people call interest. So we go from renting the house, all right, to renting money our entire lives. That's what this whole system does. It funnels money into the pockets of the rich. I am not against borrowing or lending. I am pro education so you can learn what's really happening so that you can rent your money at a much lower cost. You are in control of your loan and you don't even know it. We're in control, but we don't know it. My job here today is to make sure you are in control. But first, before we get started, I need to share with you someone else who has found out that this is true. His name is Dr. Eric Thomas. They call him E.T. the hip hop preacher. And he found out that he could pay off his loan cheaper and faster by using the P.I.L.L method. And it calmed things down for his wife. His wife was quite anxious about being in debt. And when he cleared that up, the anxiousness went away and she was at peace. I want you to hear from him right now.
Listen to me, y'all. But one of his mentees took us through one of their programs and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks, you heard it. If you want to know the month, day, and year you could be debt-free, and you want what's called a savings and earnings report, okay? So if you have a mortgage, let's say you have a mortgage, student loans, credit cards, car loans, you have all of that. The average family has 13 different debts. The average family is paying 35 to 39% of their take-home pay just on the interest payments on those debts. That's a lot of money. So if you want to know how to save 75% of that, then what you want is a savings and earnings report. How can you, with your current budget, with the money that you make now, save up to 75% of the interest the bank wanted to charge you, and because of that, you can now take that money you would have paid in interest and use it to pay down the principal and be out of debt in 7 to 9 years. If you want to know when you could be debt-free, then go to ice10k.com. Let me put it at the top of the room so you could see it here in Clubhouse. But if you're following us on the live show on the internet, then you want to be able to go to ice10k.com. That's ICE, the number 10 and the letter K.com. So I'm going to put it at the top of the screen here. All right. And that way you can see it. Go to ice10k.com. You'll also see a link there that says get a savings and earnings report. Follow all of the directions after you click that. And then once you follow all of the directions there, then you'll be led into our financial form, put all of your information in there about all of your loans. And we can tell you the month, day, and year you'll be debt free and how much interest you can save. That interest saved, we're going to show you the potential earnings of the interest saved. And for a lot of families, it could amount to as much as $1 million or more. Invest the money you would have paid in interest and turn it into wealth. I can't wait to talk to you about it. Not only that, but a lot of this information that we use, that we're going to be talking about today, the basis of it exists in a book. The book is called The P.I.L.L Method, A Better Way to Eliminate Debt. You can find that book on Amazon. Out of 33 million titles, it is the only book on Amazon that helps us to understand the lending industry as it is now, how they're making more money than because we don't know how the plan works. Once we know, we don't have to pay all of that interest. Then we can save that money and invest that money. We're giving the basic information out in the book so that you can know that there's a better way to do it, and it leads you to our AI system, artificial intelligence, that our computers beat the bank's computers at their own game, and you can save interest by following the prompts from the computer. It'll tell you exactly how much money to move, what month to move it in, what day of the month to move it on, and which loan to attack. And we'll figure out for you the best way to save interest. Let's get into this thing right now. Credit Goddess, how are you doing this morning? Good to see you. Let's go ahead and get you introduced. So I'm going to jump into our first example right after you say something, Credit Goddess, because people right now, if they're trying to get a mortgage, right now they're saying, how can I save money? And one of the things that they talk about is, should I get a 30-year loan or a 15-year loan? That is going to be our first subject right after you, Rose. Come on, introduce yourself. Tell us what you do.
In my opinion, a 30-year loan. Hey, everybody. My name is Rose Delore Lewis, also known as Credit Goddess. I'm all things credit, credit score improvement strategist, business credit coach, NAV business loan broker, and an educator in the credit space at Be Free University. And of course, I'm here to support Don so we can talk about how to choose your mortgage term. So definitely stay tuned. You know, tax season is coming around, and this is the prime time that a lot of people look to purchase a home around this time. So definitely tap in, share the room so that more and more people can learn about what Don is about to share with you guys. Thank you for having me, Don.
You're so welcome. Listen, folks, we have so much content to cover today. We're going to be here today and Friday covering all of these things that you use to make choices about your mortgage. 99.99% of everything you've ever been taught about mortgages, about loans, about interest, throw it away. It all supports banking. I'm going to tell you that practically everything you know to do the opposite if you want to save money. Let's get started here. If you want to see this example, I've got a few people here that are watching the example live right now on YouTube, Twitter, Facebook, and LinkedIn. If you want to see these examples, then you want to go there and search P.I.L.L Method on a secondary device so that you can see these numbers. Because right now I have on the screen a $350,000 mortgage at 6% interest for 30 years. I want to show you something that, okay, now why did it do that? Hold on for a second. 350,000, okay, at 6% for 30 years. There we go. The payment is $2,098.43. Okay, this one is going to be easy, folks. I never, ever, 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 ever get anything under a 30-year loan. If they had a 40 or a 50, I'd take it. Here's the thing. When you understand amortization, it doesn't matter how long the mortgage is, because our program only looks at how much money you owe and how to save interest on that money so that you can pay the loan off cheaper and faster. It's about interest cost, not interest rate. You're going to hear that a lot during these sessions. Interest cost instead of interest rate. So right now I have $350,000. All right. And what if, let's just say I have a client that has this loan. They can actually pay this loan off in 7 years. So if they could pay off a 30-year loan in 7 years, why get a 15-year mortgage? Okay. Here's lesson number one. Lesson number one. And if you're taking notes, write it down. All right. And listen, if you can't write notes, clip it. All right. Use those little scissors down at the bottom. Continue to share this room. You do not need permission to have a 15-year loan. If you want a 15-year loan, you don't need permission. Let me show you what I mean here. So what we're going to do is we're going to go ahead and open a new tab. I'm going to put in a second $350,000 loan, okay, at 6%. But this one is not at 360 months, it's at 180 months, okay? And I want to show you the secret here that most people do not know. All right, and 350,000 at 6%, 180 months. That's 15 years, folks. Now, here is your 15-year payment. It's $2,953.50. All right, that's a 15-year mortgage. And this is a 30-year mortgage, $2,098.43. So here's the secret. You can have a 30-year mortgage, all right? And remember what I said, you don't have to have permission to have a 15-year mortgage. Then all you would have to do is find out what is the payment for a 30-year mortgage. The payment for and then what is the payment for a 15-year mortgage? The 15-year mortgage for the same numbers is $2,953.50. Then you could make this payment. You could have a 30-year mortgage and make the payment for a 15-year mortgage if you wanted to. Do you know there are people who are refinancing, spending $10, $11, $12, even $15,000 closing cost to refinance out of their 30-year into a 15-year? When they didn't have to refinance at all, they could have just found out what is the 15-year payment and start making it. You do not have to have permission to have a 15-year mortgage. Credit Goddess, what do you say about that? Are you with us? Anybody else who wants to come up to the stage and ask questions about this, what I'm telling you is true. Now, here is the thinking on this. If I have a payment of $2,098.43, and all I know, let's see, all you know, you don't know anybody from the P.I.L.L method, you don't know us, you've never seen any of the videos, but you did hear this. Here's what you heard. You can get a 30-year mortgage, pay the $2,098.43, or find out what the 15-year payment would be. That would be $2,953.50, and start making that payment, the $2,953.50. But what happens, folks? What happens if things get a little tight? All right. And you know, life gets in the way sometimes. When life gets in the way and you've got a payment that's nearly $3,000 even before taxes and insurance. We're not even paying taxes and insurance yet, and your payment is almost $3,000. If you have a 15-year mortgage and things get tight, you have no place to go. You've got to make that payment. You've got to make it, or they're coming to get the house. If your regular payment on a 30-year mortgage is $2,098.43 instead, and let's say you've been used to making that higher payment of $29.53. Let's say you've been used to making that higher payment for 5 years, but things get a little tight. Life gets in the way. Something happens. One of you loses a job. Guess what? You can drop back down to the $2,098.43. That's your regular 30-year payment. Did you know that to be true? And folks, does that make sense? If that makes sense to you, go ahead and say something in the chat. If that makes sense to you, what we're talking about, go ahead and say something in the chat. Put a number 9 in the chat or make a comment if this makes sense to you. Did you know you did not need to have permission to have a 15-year loan? It's the same thing with a 10-year or a 25-year or a 20-year. I never, ever recommend getting anything under a 30-year loan. And if your company offers a 40-year loan, take it. So if it is possible to pay off this loan in 7 years, why would you add the extra stress of adding on about $900 a month dictated by the banking industry? Why would you do that if you didn't have to? All right. So anybody got any questions before I go into my next situation here? Because you do not need to have a 15-year loan to have a 15-year payment. Oh my goodness. Somebody from Facebook, Miss Renita Perry, says she's put a number 9. Toyo, and she's coming here, tuning in all the way from the UK. And let me see. She says rates are higher in UK, 4 to 6% for fixed rates. Okay. Yeah, Toya. We're on YouTube again. Yep, it's on YouTube. And let's see, 3 to 3.5 on standard variable rate. Yeah, listen, I don't care about interest rate. Okay. I don't care about interest rate. I just care about interest cost. All right. Now, what do I mean by that? The next thing we're going to talk about. So that is 15-year mortgage versus 30-year. Okay, 15 versus 30, and anything else. If you want, just find out what the payment is, folks, for the kind of mortgage you want, and start making that payment. If that's all you know, just find out what the payment is. Stop refinancing to get a lower term. All right. Now, if you have a lower term, all right, did you know you've just made it harder to pay the loan off earlier or faster or cheaper? You just made it harder by lowering the term. Yeah. Okay. Does anybody want to see that? If anybody, listen, we've got 14 shares already. Okay. We got 14 comments in the chat section already. We've got 6 shares. Go ahead. I see Brenda in here and I see Tiffany. All right. And I see some new faces. Aminta and Daryl is in here. Charlene's in here. Berna is in here. She's been in here before. Julia is here. Rhonda is here. Lisa is here. I am so glad to see you all this morning. And we're going to go over. Listen, if you have something that you want to ask, all right, because I've got at least 15 things here to go over between now and Friday. So we're going to do as much as we can today. We'll finish up on Friday. But listen, we just talked about 30-year, 15-year, 10-year mortgages. Never get anything under a 30. And if your 30-year pays off in 7, why would you ever want to burden yourself with a higher payment? Now, let me show you something about getting a 15-year mortgage versus a 30-year. You want to know? You want to see another thing that's different about this? Watch this. Right now I have the 30-year mortgage up on the screen, and we're going to scroll down and take a look at the principal payment. Here's the next thing you need to know, okay? Control the principal payment and you control the loan. Control the principal payment and you control the loan. All right? So the principal payment here is $348.43 on the first payment, and $1,750 goes to interest. So Don, look at that interest cost each month, $1,700. So two things you want to write down on this one. All right? Control the interest payment and you control the loan. And interest payments you skip don't matter. Interest payments you skip don't matter. So I have this mortgage, and let's say I make my payment on January 1, I make my payment, $348.34 goes to principal, $1,750 goes to interest. And then when I pay my $348.43 and subtract it from what I owe, I'm left with the principal balance on line 1. I use the principal balance on line 1 to figure out how much interest I pay on line 2. That's how it works. Okay? Next month, I will pay $1,748.26. So it doesn't even go down by $2, folks. Not even $2, about $1.74. That's it. Okay, my interest cost here. So that's what you are worried about. What is the interest cost on managing this loan, not the interest rate? Okay, because the interest rate, okay, that's one of the things we're going to go over next, is the interest rate is a liar. Okay, they want 6% on this loan, but by the time I'm done over 30 years, I will pay back 115.838%. So the interest rate is a liar. So we're going to go over that in just a few minutes. So now take a look at this loan. On payment number 2, my principal payment is only $350. So if I make payment number 1 in January, and then I look at February's principal payment, which is $350, there is no rule that says I have to wait until February to give the bank the $350.17 they're looking for. I could actually, if I have it, I can pay it in January as well on top of my regular payment. I can totally, by doing that, I can totally eliminate line 2 from my mortgage schedule because the $350.17 goes straight to principal. I pay no interest out of it. And my next mortgage payment is on line 3 for doing that. That's how that works. Okay, that's how that works. And what just happened, I got rid of line 2 for $350.17. I just saved $1,748.26 in interest I never have to pay. Now watch this. When I go to the 15-year loan, now remember, control the principal payment and you control the loan. Let me show you what happens when we go to the 15-year mortgage and look at the principal payment now. Look at it. Look at the principal payment now. It's $1,250, $1,203.50. $1,200 now I have to come up with. So if I make this payment, look at how that works. I make the first payment, and in January, but if I want to get rid of February's line, I have to come up with another $1,209.52 just to save $1,700 in interest. Oh my goodness. Listen, somebody else should be blowing up the chat right about now. Blow up the chat right now. Did you know that? By lowering the term, we're not even lowering the interest rate, by lowering the term from 30 to 15, this is what you're doing to yourself. Now you tell me, is it easier to get rid of line 2 for only $350 if I have a 30-year mortgage? Or should I go to a 15-year mortgage where I have to come up with a total of $1,209.52 to get rid of one line? and the interest on that line. But look at my interest payments. Starts out at $1,750 here. Starts out at $1,750 here. The next one is $1,748.26. Here's $1,743.98. Almost the same amount of interest. I can get rid of almost the same amount of interest for my 30-year loan if I have a $350 payment, but on the 15-year loan, I got to come up with $1,200. Who knows this to be true? The bank's owner knows this to be true. The people who own the bank or the mortgage company know this to be true. So if you go in to the mortgage company and start asking for what is the best way to, I don't want to have my mortgage for 30 years. They're going to tell you, well, go in there and get a 15-year mortgage, and then you can have it for 15 years. And you're thinking, great, I can do that. But what we just learned is another thing that we're going to be talking about in just a little bit. The 15-year versus the 30-year term. You see, when the mortgage company, I just dropped my pen. Hold on. All right, I got it back. All right, when the mortgage company compares the two mortgages and gets you to choose, they're getting you to look at what you would have to pay for 15 years and what you would have to pay for 30 years. They're comparing a 15-year loan, which means you have to stay in the loan for 15 years to realize what they're talking about, or a 30-year loan, which means you'd have to stay in the loan for 30 years to understand these numbers. Let me show you what we're talking about here, okay? So let's take a look at the 30-year loan at the closing table, all right? At the closing table, at 6%, $350,000, the interest paid that the bank is looking for is $405,000 on a $350,000 loan. Folks, look at that. $405,000 interest on a $350,000 loan. This is what you see, okay? Now, and that is a total interest paid as a percentage of principal, 115.839%. You're paying more in interest than you borrowed in principal if you keep this loan for 30 years. But when they talk to you, they're showing you the interest cost for 30 years. But folks, who says you have to stay in the loan for 30 years? Who says that? You do not have to stay in the loan for 30 years. In fact, P.I.L.L method clients get out of debt in about 7 to 9 years. So if that's the case, there's no way we're going to have to pay $405,000 interest because we're not going to be in the loan for 30 years. We're going to be done in 7. So what they're doing to trick us into getting the higher payment is to say we're going to be out of debt in 15 years by showing us this. Do you want to pay $405,000? Or if you get the 15-year loan, we chop it down to $181,630. Which one do you want? $181,630 if you keep it for 15 years? Or do you want the payment? Do you want to pay back $405,000? Well, no, and nobody in their right mind would say, I want to pay $450,000 when I could pay $181,000. But folks, they're comparing a 30-year loan full term versus a 15-year loan full term. But now, you don't have to keep it full term. Oh my goodness. All right. So Toya from the UK is saying in UK, there is an early repayment charge. Well, yeah, if there is, there's an early repayment charge. There's an early repayment charge in the UK. It's common in Canada. It's common in Bermuda. It's common a lot of places that you have to pay a charge. You have to pay they're going to charge you to prepay. But here is what you don't know. Here's what you don't know. they're going to tell you there's a fee, there's a penalty for prepaying your loan, paying it off early. But what they don't go over is how much interest you save. They don't do that. So let me give you an example of that, okay? Just one example. If you're online looking at this, all right, I'm showing you cumulative principal and cumulative interest. Cumulative principal and cumulative interest, okay? So what we're talking about is prepayment penalties. All right, I'm making a note down so I'll know what I talked about today, so I don't talk about it again on Friday. Prepayment penalties is what we're going over now, okay? All right, prepayment penalties. There it is. So let's just say, just a quick example here. Look at cumulative principal and cumulative interest. All of this money here, $4,298.07. That's how much principal you pay in 1 year by making 12 monthly payments. Okay, there you go. 12 monthly payments. And if you do that, we're taking these $300 payments and adding them up for 1 year. It comes to $4,298.07. But you also, if you're making 12 monthly payments, all right, now you're also making $1,700 payments in interest each month. And when you add all of that up, it comes to $20,883.09. So doing it the bank's way, to get the equity, all right, to get the equity of $42.98, because now you're creating, what you're doing is creating equity. You're now creating space between what you owe and what the house is worth. So you owe $4,298 less. So you now have $4,298 additional equity. Does that make sense? But look what the bank is charging you for that equity. $20,883. So let's say I could prepay and the bank wants to charge me money. All right. So if we were to prepay this loan in Canada, let's just say, just take this number here, the $42.98. There's no rule that says I have to take 12 months to pay that. If I have the money, I can actually pay that all at one time. All at once. Okay? I can pay that all at once if I want to. Okay, Toya wants to come to the stage, so we're going to bring her up, invite her to speak. Great. All right. Anybody else who wants to come to the stage and ask a question can do that as well. All right. So listen to this, folks. So if I have the $4,298.07, I can prepay that before it's due. I can pay that. And guess what? I'm paid to line 12 in just 1 month. I just saved a total of $19,152.74. So I now found out I could prepay. Now I know how much interest it's going to save me. I'm going to save $19,000 in interest. Now let's go to the bank and figure out how much interest it's going to cost me. Now let me see here. Let me do a quick calculation here and I'll tell you what it would cost in Canada to do this. We did this a little while ago. We're going to take, let's see. Okay, wait a minute, 1,200, and we're going to divide that by, there we go. All right, now, what if you could save $19,000 in interest, and your bank said, oh, to save that, you prepaid, but now you owe us a penalty. What if they told you your penalty was $240? To save $19,000 in interest. The reason why prepayment penalties are so strong in our heads is because we don't know what our benefit is from prepaying. All we know is what is the penalty for prepaying. If you don't know what the benefit is, then the penalty looms larger in your mind. Folks, listen, what if I just asked you, give me $240 and I'll show you how to save $19,000. Let's put it that way. Give me 240. I'll show you how to save $19,000 that you don't have to pay on your mortgage. You would jump at that in a heartbeat. So always know what's going on here, folks, when it comes to that. Toya, come on, talk to us this morning. Tell us who you are, where you're from, and let's get your question in.
Thank you so much. Good morning. My name is Toya. I am a full-time employee in London, living in London. I also try to do some investments on the side. Um, so at the moment, the home I live in, I'm due to remortgage in April. Usually in England, you can reserve a rate from 6 months to anytime beginning from 6 months to the end of your product. So I had a mortgage for this apartment. It was 25 years when I took it. I think I've got 14 years left. And so two times I've had two products, a 5-year product and another 5-year product. So the second 5-year product is coming to an end now. It was at 1.99% interest rate, but obviously we all know what's going on in the world now. So I mean, I had a 1.99 fixed interest rate. So with what's going on now, the fixed rates are starting from 4, percent in UK. So we're all quite nervous. So looking at stuff, I don't remember how much the Bank England base rate is. So I've decided that the variable rate, which is where if you don't fix, you choose a variable rate, it just goes up and down in line with the Bank of England's base rate. So that seems to be more attractive at the moment because it's between 3 and 3.5%. That's the maximum. But for fixed products, the minimum you're paying is 4.5, and up to 6, maybe even 7. We have indication in the market. They're saying that they're going to start coming down gradually, but we haven't nothing material just yet. So I was just thinking, like I'm due to mortgage in April, as I said, I don't want to pay those high rates. I mean, what do I do? I've got 14 years left. I mean, I'm following what you're saying. Like I'm sitting now glued to the TV where my YouTube is on, and I'm talking all the time now. Yeah, so just looking at that, I'm like, okay, so I've got 15 years left. They would probably ask me if I want to extend it or if I want to make it longer or I want to keep it at 15 years. From what I'm looking here now, I mean, obviously, I still need to sit down, listen to you more to the end, really, not just but from here, it seems like it's going along the lines of as you've already said, take the longest period possible and then overpay,
Okay,
you know.
so Toya, first of all, before we get going, because somebody's going to hear this and then leave, I want to make sure people understand it. You can't take information from this broadcast and apply it to you and know exactly what to do. You can't. I'm giving some basic information that would cause you to say, how would this work out for me? When people ask me, Don, here's my situation, what should I do? My first answer is, I don't know. Any person that's worth their salt that is doing this for a living, giving people financial information for a living, when you ask them a question, their first answer should be, I don't know. Let's do the math and let's see how it works out for you. You see what I mean? We have to take a look at all of the variables. This is an opportunity cost question. I'm just giving some basics here so that you'll know that you want to get with a professional and say, how does this work out for me? But keep this in mind as we finish out your question, Toyo. Keep going.
Yes, sir. Thank you. That's all useful. That's very good. Yeah, thanks. That's true as well. So yeah, so looking at that, so interest rates, as I said, it's about well between depending on whether you do fixed or variable rate. So for in my case, I'll have the option of doing 15 years or meet a professional who would then advise me, and maybe could be longer, but they will look at the situation and then make a recommendation. So the thing here is, so when you have like a 5-year product, which I've had twice, w- one 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 horrible bank, the first time they did it, I didn't know much then. They gave me an early repayment charge per year, and it was fixed. It was about £5,000.
Sure.
If you call in the loan at any time earlier, you can overpay. You can, and also the amount at which we overpay here,
So
the maximum
Toya,
we
here's what I'm going to
allow.
need you to do. Go to a question that I can answer.
Okay, okay. So I think the question is, when you have restrictions in terms of, for example, you can only overpay a maximum of 10% of the original loan you borrowed, the principal sum. You have that, as well as,
Okay, let's handle that first. Okay.
okay,
First of all, read the entire statement. Number one, because what they're saying is, and most of these, it says you can only pay up to 10%, prepay up to 10% without penalty. It doesn't mean you can't pay the entire loan off if you want to. They're just saying you can't pay any more than 10% without penalty. You have to read the whole thing. Now, based on what you've learned today, is should we also learn how much interest we save if we prepay more than the 10% if we have it? Doesn't that make sense?
of course.
So if I prepay and you're going to charge me, then what am I going to save as a result of that? So if you're going to charge me a little bit of money, but I get to save a great deal of money, then I'll pay your charge every single time, because the alternative is not to prepay and pay a lot more interest than I need to pay. So folks, all of this is around what does it cost to manage my loan and what do I need to do to minimize the cost. We keep looking at how long it's going to take me to pay off the loan. We're not looking where we need to look. See, the way these loans are set up, it's a deception. We're looking at what we borrow and how long we borrow. We're not looking at what it cost to borrow. When we look at what it costs to borrow, now we start asking new and better questions. How can I borrow the money from the bank at a much lower cost? Has nothing to do with the rate. Has everything to do with how the loan is constructed and what I can do to make the loan work for me. So, Toya, I hope that answers that question. What else do you got for me?
I think that's it for now. I'll just keep listening. Thank you.
You are so welcome. So here's the other thing that she pointed out, folks. And Toya, I'm going to need your help with this because you said you had 2 5-year products, right?
Yeah, at the moment now, so I'm on a 5-year product. That was before the first five. I'm on I had a 10-year. My mortgage has been going on for 10 years. I just
Okay.
had
So
a
folks,
product that ended 5 years ago, and now this is the second one ending in April 2023.
I want to share something with you. All right. And we're going to talk about refinancing in countries that require it every 5 years. Canada does it. Obviously, the UK does it as well. So watch this.
What? That doesn't happen in America?
Oh, no. We're not required to. We just do it because we choose to do it. We choose to refinance every 5 to 7 years. You're required to do it, but we choose to do it because of marketing. We do it because of marketing. You do it because it's required. Let me show you something. Let me share something with you right now. Because you're saying if my interest rate goes up, it's going to be based, my new payment is going to be based on how much I owe. But how much you owe is going to be dictated by the banks because of how you pay off the mortgage. So your loan started out at 25 years? I'm asking.
Yeah, it started in 2013, so next year will be 10 years old.
No. I mean, what was the term? What was the original term?
Oh, sorry about that. It was a 25-year loan. So
25-year loan. Okay, 25-year loan. So here's what they're looking at, folks. If you have a 25-year loan, all right, and if you pay for 5 years the way they want you to, then you will owe exactly what you're supposed to owe in 5 years. But what if you've learned how to prepay? What if you have some money on the side and we could show you how to prepay the loan so you owe a lot less? I'm putting this on the screen right now, folks. Give me an example of this. Okay. So I have, let me go ahead and pull up a couple of more of these. All right. Now this is important. What happens if you have to refinance, and there's a great chance you have to refinance at a higher rate? What would happen if you do that? Okay. What happens if you have to refinance at a higher rate? Okay. But now here's what we're talking about. Let's put in 250,000. Okay. And what was your original weight, Toyo? You said 1.99?
200 Yes, please. 1.99, and my initial loan was 225,000.
225. Okay. 225,000
Yes, 225,000
at 1.99, and it was a 25-year loan. Okay. So that's 300 months. Let me see if I can get this to act right the first time. Nope, it didn't. Okay, let me see here. How much was it again? The original amount?
It was 225,000 pounds.
225,000 pounds. 225,000. 1.99. And 300 months. 25 years. Okay? So now, in 5 years, this is where you will be. So I'm going to go down 60 months. So we start out here, all right? And in 5 years, here's where you'll be, all right? At 60 months, you'll have paid the loan down by $36,523.98, and you'll have paid $20,630.82 in interest. Okay? Now, if they're saying now your interest rate could go up, but it's going to be based on this amount, because that's what they're figuring. That's where you'll be in 5 years. But what if you're not there in 5 years? What if you have, because of your income in 5 years, let's just say that I have clients who in 5 years are not here. They don't owe this, okay? They're closer to here, where they owe 148 instead in 5 years, because they're prepaying. So if your interest rate goes up, it's based on this amount,
A
lower amount, instead of where you would be in 5 years at 188. Okay, you could be all the way down here to 148. And if the interest rate goes up, even if the interest rate goes up, it could be that your payment is less than it was before because it's based on a lower principal balance. So here is the payment. This is just an experiment. I've never done this before, but let's just do it and see what happens. So we're going to duplicate this tab. All right. And now my interest rate right now is 1.99, and my payment is 952 pounds, right? That's just principal and interest. That does not include taxes and insurance. 952 pounds. Let's see what would happen if instead of being here in 5 years, okay, 188, let's say we're closer to here where we're 148. All right. So we're going to copy that and put that into our system. Now, when you refinance and you start at 25 years, so when you refinance, did you have 20 years left, or did you go back to 25 when you refinanced?
I had 20 years left.
You had 20 years left. So let's keep that in mind. All right. So now we go from 25 years, and we're going to go to we have 20 years left on this loan. So we're going to put that 148,134.24. Let's put that into here. Let's put that in. All right. And we're going to move this comma. And my interest rate could go as high as what? 4%? Toyo?
Yeah, let's call it 5%. Let me do worst case scenario.
Well, I know I want to do what is
I think about 4%.
about 4%. Let's do that. Okay.
Yeah, yes, please.
All right. Let's do that because that's real life. And now instead of 300 payments, all right, you have now 240 payments. Okay. 240 left. And so your payment now at 4% is not 952.58, 952.58. Let's see what your payment would be now at 4% because you owe less. I mean, got to get rid of this. Got to get rid of that and calculate. 897.66. 897.66. And they increased your interest rate, but you owe less. So, folks, here's the thing, when you're getting this information about the interest rates, we are locked into thinking we have to owe what the bank says we need to owe in 5 years. But what if we owe less? Save interest, and then our interest rates go up, but because we owe less than the bank wanted us to owe, our payment actually decreases even at a higher interest rate. Toyo, does that make sense to you?
Yes, totally, yeah.
Oh my gosh. Oh my gosh. Has anybody ever explained that to you before?
Not in this way, anyway.
Maybe.
Following.
Listen, share this with others in the UK. You do not have to worry about rising interest rates the next time around.
What does it look like, though, for the principal and the interest in this scenario?
Oh, okay. Let's take a look at it. All right. Principal and interest on this scenario is $403.88 in principal for $493.78 in interest.
Oh my God.
At the older loan, okay, the very first, you had a principal payment of over $600. Okay, 500 started at 579. Okay, when we start this new loan, our new principal amount is less. So remember, when you control the principal, you control the loan. So are you in better position here? Even though the interest rate is higher, are you in a better position here or worse on the new loan?
Let me see.
Okay. Now let me try this again. Keep this in mind. Control the principal payment and you control the loan. The lower the principal payment, the better off you are. So on your very first loan, your principal payment started out at $579, $580, and that was at the 1.99.
Oh, wow, yeah, okay.
At the 4%, your principal payment now is starting out at 403. So are you better off at the higher interest rate or better off at the lower one?
So at the lower one, if I plan to do what you've been saying, that continue to overpay, then you get more, you save more interest.
Okay. At the lower interest rate or at the higher interest rate?
You save more interest from this example at the higher interest rate.
Exactly. At the higher interest rate. And not only that, but you actually owe less on the loan because you've prepaid.
Yeah, so that's like having been prepaying even before now.
Yes. Because there's no rule that says you have to do it their way. Folks, this is mortgage gold that you're getting here. Mortgage gold. Listen, how many are there any other questions or comments? Anybody else want to come to the stage and ask a question about this?
I have another.
You
I
have
have a
another?
question. Is this? Yeah.
Go right ahead, Toya. Listen, you are in charge because nobody else is coming up. Oh, Charlene wants to come up, but Toya, go ahead
Yeah.
and with your question.
Right. So is this true in every case that when you at a high interest rate in a capital repayment system, which includes principal plus interest, in every case, if interest rate is higher, the principal will be lower and the interest portion will be higher.
Okay. So, Toyo, you and
Is that
I
right?
have conversed via chat, haven't we?
Uh, yeah, I have your. I have the contact.
There you go. So we conversed via. So I think we've talked about before that the what I'm using on the screen here is not my program. This is an internet program. It belongs to Brett Whistle. Have we talked about that? I've given you that information,
Yeah,
haven't I?
yeah.
Guess
You
what you
said
could
that
do?
on the.
You could play with this thing all day, and every time you put in a higher interest rate, the principal payment goes down every single time. You could put in the same loan, just change the interest rate each time, all right? And it continues to go down. So what if the interest rate actually, we're going to do this again on the original amount. Let's just say that the interest rate, we're going to duplicate this tab, and the interest rate actually went to the 5% that you were talking about. Or
Yeah,
let's go all the way to 7, because we're already at 7 in
yeah.
the
Let's do that.
we're at 7 in the US. Okay.
Press the gas.
She said press the gas. All right, we're going to take it at 7%. All right, that was the $148,000 at 7%. Now look at the principal payment. It's down to $286. 286 instead of, let me see here. Okay, we're at the 1.99 on this one. Okay, 225,000, all right?
Yes.
Okay? We were at 1.99. We started out at $580. That was at the lowest interest rate. But now we're looking at what you still owe. Okay? If we went to 7% interest rate, principal payment has dropped down to under $300. $284 is the first one. $286 is the second one. So if you need to prepay this loan,
Oh my
is it
God.
easier to come up with $286 or on
Yes.
the original loan come up with 580? Or I mean
Two
pounds.
hundred, of course. Yeah, yeah.
Does this make sense, folks? I hope this is making sense. When you're setting up the loan, bringing all of this information to bear is going to save you money in the long run. And let's talk about now. Toya, do you have one last question for us before we go to Charlene?
I'm quite happy for you to go to Charlotte. Thank you so
All right. Well,
much.
listen, stay by because you may come up with another one. Charlene, how are you this morning?
Hi, good morning. Thank you for having this room. Good morning to everyone.
All right. What's your question this morning?
My question actually, I was having this conversation with the family the other day. We've kind of been trying to work towards it, and I just feel like I manifested this room because my father is currently looking to retire. Recently purchased a co-op, and I'm a little skeptical about him retiring next year because he still has this mortgage loan. So I've just been sitting at the table just trying to figure out, what he can apply in addition each month just to really pay that down where he's comfortable when he does retire, or if we should push retirement a little further just to really get this loan out the way. I just want him to be comfortable.
That is a very good question to ask. So it all depends on what you're looking to do. It all depends. Okay? So
Okay.
let's just say I want a place to live that I like. I'm going to go into retirement and I am going to stay here for the rest of my life. You can look at that payment. So you can figure out what you're going to be paying in retirement. All right. So you can figure what your retirement income is going to be. And then that payment is locked in for life, except for, when they raise the taxes or insurance. But the mortgage doesn't change. Now, what if he says, I get a 30-year mortgage and life expectancy is where it is? He could be saying, for the rest of my life, I have a payment I can afford, whether I pay it off or not. That could be the thinking. That's one way of looking at it, correct?
Yes.
Another way of looking at it is, yes, I want to borrow the money, but I don't want to pay all of that interest. I would rather some of that money that's going to interest be able to go to my family when I pass on. I could look at it that way and then put together a plan whereby I am not looking at trying to pay off the loan fast. I just want to pay it off cheap. Why give the bank 75% more interest than they're looking for when I could pay them so much less interest and more of my money actually will pay down the principal instead? I can look at it that way. A third way would be I could push retirement. If I knew based on what I'm making now, what if I knew I could pay this off in 5 to 7 years? What if I knew that? And if I was young enough, could I push retirement for 5 to 7 years and then retire with no mortgage at all? That's another way of looking at it. What do you think?
Um, yeah, those are all different variations that I didn't even consider, honestly. Like, I'm looking at his account and I have all the numbers here, but I never really stopped to think about all those different variations because again, my huge concern was, oh, you're going to retire and I don't want you to retire with this cap over your head. And I would feel a lot more comfortable knowing that if we could bring it all the way down and you just had less bills, so to speak,
Sure,
on a monthly basis, you could,
sure.
yeah.
Let's see now if you want,
Mm-hmm.
we do an analysis here at the Pill Method,
Okay.
and let's
Okay.
just say, now here's what we don't do. We're not going to give you like a spreadsheet and it says, okay, here's what you do. Here's a sheet of paper, and here's what you do to accomplish your goal. What we're going to do is say we're going to take a look at a couple of different scenarios and say if you did this instead of this, you could be out of debt here, or you can keep this payment forever, or whatever. But if you want to know exactly what to do, we have a computer program that tells you exactly what to do to accomplish your goal. First of all, we need to figure out what the goal is. Is the goal to pay it off? Is the goal to save as much interest as possible? Or is the goal, I just need a comfortable payment for the rest of my life? Now, some of that we can help you with, and some of it we can just give you some good advice. But if you want to pay that thing off in the next 5 to 7 years, and you can still retire in a time that makes sense, then you will need our program for that. And we, by doing an analysis, we can help you to determine where is it that you want to go. So a conversation with you and your dad, figuring out what is important to you, and let's see how we can get you to your financial goal in the way that makes sense for your dad.
Right.
Okay? And you got to find out what he's looking at. What is he trying to do? And once we find that out, the story could be, yeah, I want a payment I can afford, but when I pass on, I don't want to leave a bigger burden than I have to my family. Let's see what we can do about that. And we can work on it. We can work on it together.
Okay. Yeah, because he's looking at a $60,000 loan currently.
Yeah.
So, okay.
Does that make sense? So listen, you could go to my link above, click on that link, and you'll see that there's a button that says Get a Savings and Earnings Report. Or you can go straight to our website, pillmethod.com. All right?
Yes, yes. I started to, and they said, "Oh, you know what? Since I have a few minutes here at work, let me do this page." So I appreciate it. I do.
You are so welcome, Charlene. And thank you for coming to the stage. And do you have any other questions for us today?
No, no, no. I will take the steps within going into that link above and just following the step by step.
Oh my gosh, folks, we're getting into some really good stuff here. Thank you for coming to the stage. Do I have anybody else raising their hand to figure out how to get the best mortgage terms? What's happening when we go to the bank? All right, so here's the next thing. Here's the next thing you need to understand. Okay? Please, 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 please get your financial and your banking information and your education from someone other than the one who's selling you the loan. That's where we are. That's where we are right now. When you're sitting down with your loan officer, you're believing that they have been instructed in how loans actually work and that they can give you advice on the best way to arrange your loan. I'm telling you, as sure as I'm standing here, even if there are loan officers in the house right now, in this club room right now, I'm not telling you anything that is untrue. Loan officers are taught how to sell their product. They're not taught how to put the products together in a way that will save you the most amount of money. They're not taught that. They're taught how to sell the product and give the illusion of saving money. Now, here's the other thing. All the loan officers I know, all of them that I know, are doing the best they know how with the information they have. That I can tell you. All the ones I know are doing the best they know how to do with the information they have. But if they had more and better information, they would give it to you. Do you know why? Because loan officers are paid a commission. If they can save you even more money by using some of these strategies, then instead of you buying one house, maybe you could buy 3 or 4 or 5 in your lifetime. And because they share this information with you, you're going to keep coming back to them. They get a commission off the sale. It has nothing to do with how much interest they don't. You don't pay the bank. They get a commission off the sale. So if they can put you in a better position than every other than any other loan officer out there that distinguishes them from the rest, that you're getting superior information from this loan officer. Guess what? Guess what you're going to do? You're going to tell other people about this loan officer that saved you so much money. All right, folks, listen, any other questions out there? Because we're getting ready to go to the very next thing. We already talked about, should we get a 30-year loan? Let's talk about down payments. Ooh, should I do a down payment on this loan to save money? Anybody want to know? Okay, now I got some questions here in the back. All right, JP, the 2% strategies you're using. Oh boy, come on, Jake. Why are you guys gonna come in here and start trying to sell crypto in here and then leave? All right, bye. Delete that. All right, I need somebody just to do that, just to delete these things that people come in here. They're called hit and run. They come in and drive by, leave these little messages, and you know we peep their game. We know what's happening. Coffee, what are you doing down there? I'm sorry, I didn't set this up right, did I? All right, there you are. Lady Miz, what are you guys doing down there? Come on up, speak. All right. Coffee Brown, how are you doing?
I am good, Don. Good morning, everybody. Hey, Credit Guidance. Hello to all those on the stage. Ice, how are you today, sir?
I'm excited because we've got at least 13 different things on how to set up the mortgage properly. And it's going to take me 2 sessions, this session and on Friday, to get that done. And on Sunday, guess what? Because this is tax season, I'm going to
Yes,
share
sir.
with everybody. I'm going to share with everybody the biggest loophole in the world, and it's not contained in the tax code. Ah! Come on.
Wow.
The biggest loophole in the world, and it's not contained in the tax code. I'm going to show you how to get 100% return, 200%, maybe even 400% return on your money, and you don't have to pay a dime of tax ever. That's on Sunday.
Way too much, Don.
You don't want to miss that one.
You play way too much.
You don't want to miss Sunday. We're going to be in the mortgage syndicate for that. Coffee, tell us who you are and what you do, please.
Don, I'm about to hit and get in with a client, so y'all just check my bio out for more information.
Thank you so much for being here. Lady Miz, how are you doing today? Lady Miz, are you there with us today?
I am sorry, I was hitting the mute button. It wasn't coming off. Good morning. How are you?
I'm doing fine. I'm doing fine. What do you have to say to us today?
I am here for everything. You know that. Like I said, I'm always just happy to be in your room to get the value that you give and to learn. I can't wait to get started. And it was a pleasure interviewing you on our podcast. Everyone loved the information that you were given, so that was definitely a plus for everybody to be able to get that. And I just want to stay connected.
Well, thank you for being here because, man, we're talking about some marvelous stuff, and I was getting ready to go into another thing. It's called down payment deception. Down payment deception. All right. If you have to leave the room before I get to the end of this, let me tell you where it's going to go, and then I'll show you the numbers behind it. Never, ever, 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 never, ever, 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 ever put a large down payment on a loan if you can help it. Now, sometimes we have to do stuff to, if there's a certain house I want, but I need to keep the payment at a certain point, then you do what you need to do to get the payment where you need to. But if the payment doesn't matter, don't ever put a large down payment on a loan. What do you think about that, Lady Miss?
I can't wait to hear the method behind that because I always thought put the largest payment down to make your payment monthly payments lower. And my daughter just did that not too long ago when she bought a new car. She put down a very large amount, and I'm thinking that's a good thing. So I wish I knew this information before that.
Well, yeah, and don't do it for a car either. Okay, on a house or a car, don't put a very large down payment down. Now, here's the thing. I ask people all the when we have a consultation. I say, here are the two loans that you can put a down payment down or not put a down payment down. Can you make the larger payment? Okay, they'll say yes or no. But if they say yes, they'll say yeah, but I really don't want to have to do that. Okay, but if you can make the larger payment, let me show you what happens when you do. If you all want to see this, please go to YouTube, Facebook, Twitter, LinkedIn, search P.I.L.L Method, and go to our live broadcast and on a secondary device on your tablet or on your laptop, and you can see these numbers. We're going to go over down payment deception right now. So let me put that in my list. We're doing down payment deception. All right. because we're deceived into thinking by making that down payment, we're putting ourselves in a better financial situation. All right. So, Lady Miss, I'm going to get some information from you. I got a $350,000 mortgage here at 6%. All right. And I may have a little bit of money that I could put down. Give me a number. Give me a number I could put down on this thing. Put myself in a better position.
20,000.
20,000. Let's do that. Okay. So I could have this $350,000 mortgage at 6%, or I could pay an additional 20,000 and get it down to 330, right? Yeah, 330. So let's do that. Let's go ahead and duplicate this tab. And then I'm going to put in here $330,000. So, all right. So here is my payment, $2,098. All right. Or I could take $20,000 and do this, put it down as a down payment, have 330, same interest rate, everything is the same, except my new payment now is not that, it's now this. It's 1978.52. 1978.52 versus 2098.43. So and then let me take a look as this is how the banks are going to sell this thing, folks. They're going to show you the lower payment. That's number one. The second thing they're going to show you is over a 30-year period, you're going to pay back $405,000 in interest. But when you put the $20,000 down, it drops down to $382,000 in interest. So it's still a lot of money. But when I'm looking at that, I got $405,000 or I've got 382. Okay? So far, putting $20,000 down looks like the thing to do. So let's just do a little bit of math here. All right? So I'm bringing up my calculator. I'm putting it on the screen. And I'm going to put in first my $405,000 that the bank wants over 30 years. Now, remember, from a previous example, this is based on 30 years. And that's what fools us into putting our down payment down here. That's what fools us because we're looking at 30-year numbers. With the P.I.L.L method, you're going to be out of debt in an average of 7 to 9 years. So these numbers don't matter. But I'm going to show you what they're taught to show you. $405,434.80. All right. So now we're going to take a look at the other one, 382. So we're going to subtract 382,267.20 equals I'm saving $23,000 by putting that $20,000 down. Now, here's the thing. They're telling you you're saving $23,000. But remember, what term did they give you? You have to keep the loan for the entire 30 years to realize this $23,000 savings. Isn't that crazy?
Yes, it is.
All right. So now, Lady Miss, what if we did this instead? I'm going to tell you, let's take the full $350,000. Okay. So if I get this loan and I close on this loan and I didn't put my $20,000 as a down payment to get it to 330, where's my $20,000 if I get this loan? I still have it, don't I?
Yes.
Huh. So if I still have that, and if I was willing to give it to the bank before the loan closed, what could I do with that $20,000 now?
Well, it's a few things you could do with it. One, you could keep it in the bank and get the interest, or you can apply that to the principal amount.
What? Listen, were you listening when I was talking on your podcast?
I was.
Did you hear it, folks? She said, I could take that 20 and apply it to principal. Let's see what happens if we do. Okay? Because here's why I like using Brett Whistle as our teaching tool, because I can go to cumulative principal, right? And I can go down to where it says $20,000. So, folks, we're going to go down to where it says $20,000 in cumulative principal. That's 1 year, 2 years, 3 years, 4 years, 4 years, and 1, 2, 3 months. That takes me down to payment number 51. What? Because remember, I wanted a $330,000 payment. Look, don't I have a $330,000 payment if I pay it after the fact? But I just knocked off over 4 years off this loan. I just saved a total of $85,000 right now. Not $20,000 over 30 years. I just knocked off 85 grand in interest I'll never have to pay. Boom! Instant savings on $20,000 worth of equity. Just like that. Taking the 20 grand and knock off 4 years instead of putting my 20 grand down as a down payment and starting out at payment number 1. So, folks, what do you guys think about that? If you think that's hot, let's see some number 9s in the chat. If you think that $20,000 put as a down payment or as a prepayment instead of a down payment is hot, where you save even more money, come on, folks. Put some number 9s in the chat. Tiana says, is that the same 20K better used as a payment to principal or buying down the interest rate? Okay, there we go. All right. So let's see. So we've got down payment deception. All right. So, and we're going to cover paying down, okay, buying down the rate. Buy down the rate. We're going to do that next. All right. We're going to do that next. All right, folks. So, let me go back to the room. Because I was in the back chat. Folks, are you hearing this? So we've got, sounds good, but I missed some of it. Oh, using it as a prepayment rather than a down payment. Yes. That's what we're talking about, Toyo. We're looking at paying it as a prepayment, not as a down payment. I never, ever put a large down payment on a loan if I can avoid it. Okay? Put down as much as you need to get into the loan, but take the rest of that money and you can use it as a prepayment. All right? And knock off years and save you tons of money. Are there any other questions about? Okay, so, all right. Toya, you got to remember to turn your volume down on your TV because we can hear it. So, Toya, do you have another question for us?
Yeah, that's right. Sorry about that. Yeah, I've been sort of drifting in and out. That was quite useful. So here in the UK, we call them overpayments.
Overpayments, right?
Overpayments. Yeah. So basically, if you've got some money, rather than use it as a down payment, to reduce your loan, take that. The money works harder.
Yes.
It's better utilized as a down payment.
As an overpayment.
As a prepayment over time. Yeah, overpayment over time.
Exactly, because it's the same amount of money, but it does more work. So that same amount of money before you close on the loan does some work. But after you close on the loan, does infinitely more work. It does a ton more work for you after the loan closes. All right. So Berna Olmsberg says, she puts a number 9 in the chat. Thank you, Berna, because she's watching us on Facebook right now, folks. Listen, if you're on Facebook, if you're on YouTube, share the room. go ahead and share the room. Look, we have 29 minutes left in this room. I'm not, and listen, David Hunt says that I've got so much information to share with you. Don't worry about it. We're going to pick it up again on Friday. But someone in the chat, if there are no more questions about down payments, someone in the chat actually wanted to know something about, should I use that money as to buy down the rate? So let's take a look at it. All right. So now the rates right now are around 7.25. I'm using the 350. Okay. 350. Okay. 7.25 as the interest rate. Okay. 7.25. And then we're going to take some money and buy down the rate to 5%. Okay, 5%. All right, 350,000. All right, 350,000. And there is my information. I'm buying it down to 5%. And here's my other loan at 7.25. All right, 7.25. There we go, right there. So so this is what we're talking about. Let's just say I have an opportunity to pay $12,000 to buy down the rate. Okay. And if you have to leave before I get to the end of this, know this so you can watch the replay. I never, ever, 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 never, ever, ever, ever buy down the rate if I don't have to. Okay. Only in certain situations where I have to have a certain payment. But if I don't have to have it, if I would like a lower payment instead of whether I need a lower payment, that is a different question. But if I would just like to have a lower payment, I never buy down the rate. It's not worth it. Let me show you what I mean. So here's my payment, $2387.62. All right, $2387.62 on my loan, and the bank wants $509,000 in interest. That's really 145% of what I borrowed. All right, listen, that is if I keep the loan for the entire 30 years. All right, or I can get this 5%. Look at the payment, $1878.88. As opposed to, look at this payment, $2387. Let me bring my calculator back up. I'm buying down that rate. Whoo, man. So I could get a $2,387 payment. Okay, 0.62. That's my payment. But I can afford it. All right. Or I could pay $12,000 to buy down the rate, buy points, and get it down to 5%. My new payment is $1878.88. So let's do the math. $1888.78. So we're going to subtract that. $1878.88. Boom. Equals $508.74. So I can get my payment down by $508.74. $508.74. $508.74. Now, here's what you're going to be told to sell this to you. It's going to cost you $12,000, but your payment is going to go down by $508.74. Take the $508.74, divide that into your $12,000. That will tell you how long you have to stay in the loan to recover your fee. That's what you're going to be told. Okay, so let's do it. So we're going to take the $12,000, okay, $12,000, and divide it by 508.74, divide it by 508.74, and that's going to give us 23 months, okay? 23 and a half months. Let's just say 2 years, okay? In 2 years, because my payment is lower, I will recover my $12,000. Folks, that's how it's sold. But I'm trying to tell you, don't worry about that, because instead of taking my $12,000 and buying down the rate, I need you to look at a couple of things here. Number one, at a 5% interest rate, look at my principal payments. They start out at $420.55. Remember, when you control the principal payment, you control the loan. Okay? At the higher interest rate, look at my payments. $274. Look at that. $274. Man, oh man. So if I want to attack this loan, I attack it with the principal payments. I can much easier come up with $274 to eliminate $2,000 worth of interest. But Don, they said, look at the interest payments here. They're much larger. Remember, control the principal payment, you control the loan. Interest payments you skip don't matter. So let's say I want to prepay 3 of these. Okay, I eliminate over $6,000 worth of interest just by prepaying 3 of these principal payments. I eliminate $6,000 in interest I would have paid anyway. So why worry about the interest cost skipped if I have a much lower principal payment to work with? Now, here's the other thing. I still have $12,000. I could have used my $12,000 to get this loan here and save myself $500 a month. But I still have my $12,000. I could take my $12,000 on my 7% interest rate. Let's go to cumulative principal here. Look at cumulative principal. Look at cumulative interest. All right, are you ready? Somebody got put just something else. It says, wow, I'm already shocked. Tiana says, I'm already shocked. Okay. So now let's take a look at my $12,000. Let's take a look at cumulative principal. That's 1 year. I'm going to put it down as a prepayment on this loan. That's 1 year. I'm at 33. 2 years. Okay. I'm at 7,000. 3 years. 3 years, 1, 2, 3, 4 months. I can knock off 2 years, 3 years, and 4 months by prepaying the $12,000 to this loan instead of using it. Okay, so Jarek Powell, come on, man. Don't come in here and talk about selling Bitcoin. Get out of here. We don't need that. Stop putting that in my chat. Okay, we're checking you. I'm gonna start blocking these people, okay, when they come in here and do that. Next time around, you get blocked. So what they do, folks, is they run in, post it, and get out before you can block them. That's the new strategy. Do you see what I'm talking about, folks? Do you see what we mean? These are strategies that are taught by banking that looks like it's saving us money when we could do the exact opposite and save way more money and time. $12,000 applied to this loan knocks off over 3 years and saves me $81,000 in interest I do not have to pay. Whew! I am worn out by going over this. And does anybody else have anything to say? Listen, does that sound like good news to you? If that sounds like good news to you, I need to see some more number 9s in the chat. Give me. Gloria Stewart says, unbelievable. Unbelievable, she says. Listen, folks, we've been trying to teach this for years. We're getting the information out. We're doing more podcasts. And listen, I just did a podcast with Lady Miz. Lady Miz, can you still talk to us? All right, maybe she's busy.
I can. I'm in the car. I'm on my way to work, but can you hear me?
I can hear you.
Okay.
All right. So, Lady Miz, how hard was it to get us to do your podcast?
It wasn't hard at all.
Okay.
The assistant got in touch and we just scheduled it and communicated by email. It was very easy and simple.
Listen, folks, on my 10K card that you see at the top of the screen, ice10k.com, you click on that. There is a link there that says, get down for your podcast. All right. You can fill that out. My assistant will get it. And then my assistant and you will set up a time where I can do your podcast. All right. So if you want us as a guest on your podcast, boom, you can get that done by going to ice10k.com. ICE, the number 10, the letter K.com. And then you'll find a button down towards the bottom. Just scroll down and you'll see how you can get Don Daniel, Iceman, as a guest on your podcast. So, so tell us again one more time, Lady Miz, what was the reaction to your guests from the information they received on your show?
They were blown away. I mean, people, and they still are contacting me about it, and people are still going back and reading it. I'm getting text messages all day long in reference to the information that you gave. So it's definitely helpful. And I know that people are going to be making the necessary steps to better themselves in their position with the loans and the debt that they have to eliminate it based off of the information you gave. So yeah, people were excited.
Oh my goodness. Folks, do you have any other do we have anybody else that wants to come to the stage? Because in 3 minutes we're going to turn off hand raising. In 3 minutes I'm turning off hand raising at 1:45. Okay? At quarter to the hour I'm turning off hand raising. So listen, come if you want to come to the stage, come now while you have the chance. All right. So, Steve Max says wants to come to the stage. All right, come on, Steve. Come on up, man. What do you got to say to us today? All right. Steve, how are you doing, sir? Go ahead and hit that mute button.
When you saying, oh, how you doing? Hi, everybody. When you saying don't put the large down payment, how do you do that? You just go with the lowest amount? How can we say if I was buying a house from you,
Right.
and it was at a high interest rate, and it was 13,000, you was telling me, or 14, I had to bring to the table, FHA, conventional.
No, no,
How
no,
do
no,
I
no, 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 no. I'm not
how do it
saying.
work?
I'm saying you have to do what you need to do to get into the loan. But there are people who put over and above what they need to get in.
Okay, so go with the bare minimum.
Go
Now,
with
how
the
do I
bare
know it's the
minimum.
bare minimum? How do I know that?
I'm sorry?
How would I know that?
They'll tell you what the bare minimum is.
Okay,
It's going to be, if it's FHA, it's going to be 3.5% of the negotiated price.
right.
That's the bare minimum.
Conventional.
Yeah, and it could be as high as 10% on some of these others. All right, but here's the thing: once people get that, some people have a lot of extra money and they want to listen. I want to lower my payment even more, so I've got an extra $50,000 here. I got an extra. I've got people that we work with that put $200,000 and $300,000 and $400,000 down as a down payment on a loan.
No.
Oh yeah. Oh yeah. So listen, if they're in California and sold their house and moved to Alabama, oh man, they've got a couple of $1 million now. Okay? What are they going to do with that? They're going to put a large down payment on a house. Okay? And they can get more house in Alabama than they could in California.
Right.
So they have the money, and some of them put a large down payment on, and you don't need to put the minimum down, and we'll show you how to use that money as a prepayment to the loan and save more time and save more interest.
Okay.
Does that make
Thanks
sense?
again, I appreciate you. Yes, sir.
All right,
I
Steve.
read your book too. They need to read your book.
They need to read the book. Listen, we're going to talk about the book in the last few minutes. So, folks, we have reached that time where we've got to go in and turn off hand raising right about now. Go ahead. Let's see. Hand raising. And now it is off. All right, folks, we're going to finish up with one more. I think I can get one more example in here. One more example. All right. And if you want to come in on Friday to talk about it, we can. All right. So we're going to leave with one last one. Some people right now have an opportunity to refinance. And even at the higher interest rates, they're refinancing and then taking cash out to pay off high interest loans, credit cards, their car loan, maybe some of their student loans. So they're taking that cash out and say, listen, if I take this cash out, I can eliminate like 10 loans and the monthly payments on those loans. By doing that, my monthly expenditure goes down. I'm saving money per month, and I'm using my 7% loan to kill some of these credit cards, which are at 28 and 29%. Wow. So here's what you need to see when it comes to taking, I'm going to give you an example of getting a mortgage, getting your equity out to pay off high interest loans and rolling them into your mortgage. Don't do it. Here's why. Okay. So let's go back to our original, our $350,000 loan. Okay. Let's just say we paid this thing down to $300,000. We paid it down to $300,000. Okay. And if we paid it down to $300,000, this is what it would be looking like. We paid it down to $300,000. We're going to take that out. Okay. It's at 7.25. Okay. 7.25. And we're down to here. Okay. This is how much we owe now. Okay. We owe $299,000. We were at $350,000. Now we owe $299,000. Okay, $299,000. So we paid that down. So now we're going to take $50,000 in high interest debt and roll it back into this mortgage. Okay, we're going to roll it into this mortgage, but we're going to, instead of 200, we're going to take this 300. We're going down to 300. Well, let's just round it to $300,000, and we're going to add $50,000 in closing costs and old debt. So now we're back up to $350,000. But let's just say we can get a new interest rate at 5%. So I took $50,000 of high interest debt, rolled it into this mortgage, okay? And I got a new interest rate of 5%. But now I've got rid of maybe over $1,000 in monthly payments. So the amount of money I've got to pay monthly, $1,000 less. And I've taken interest rates that I had that were way higher than this and rolled it into the mortgage. And so now my new payment on all this debt is $1,878.88. Now, remember, I was down to $300,000. I rolled in the old debt, and some of it was as high as almost 30%. Now, let's take a look at what happens, because I got to pay back the $50,000 I rolled back in to get down to the $300,000 I had before I refinanced, correct? All right, listen. If you're excited about this particular example, you need to blow up the chat, okay? You need to blow the chat up once you see this, all right? Watch this, folks. Now, let's go down to the loan, and remember, we need to pay off the first $50,000. And most people who don't know the P.I.L.L method just make their regular monthly payment from now on. Okay? And guess what? Most people don't realize that you just got a brand new 30-year loan when you did this. And folks, it doesn't even matter. If you were down to 300 payments, it would still be bad. Okay? So don't even worry about the fact that you paid into this mortgage already. You're at 5, 6, 7, 10 years in, and then to roll debt in, you get a brand new 30-year mortgage, okay? Because that's what happens to most people who get this refinance deal, okay? So watch what happens here. We're going to pay back the first $50,000 because that's what we rolled into the loan. Now, remember, the highest interest rate we had was 30%. Let me show you what happens when we do that. We're scrolling down. We're scrolling down. All right. At 24 months, I've just paid off 10 grand of that. At 36 months, I just paid off 16 grand. Let's scroll down to $50,000. So this is 5 years, 6 years, 7 years, 8 years, 8 years, 1 month, 8 years, 1 month. It takes me to pay off the $50,000. I just paid it off, okay, in 8 years. All that debt. And the highest interest rate was 30%. I need you to see how much interest you paid on the 50 grand you rolled into your mortgage, even at 5%. You just paid $132,000 in interest on a $50,000 loan because you rolled it into your 5% mortgage. What? So here's what we're talking about, folks. If you borrow $1 from me and I say pay me back $2, do you realize that is 100% interest? Okay, yeah, I got the dollar back plus another dollar. Okay, 100% interest. If you borrow $10 from me and I say pay me back $20, that is 100% interest. So, folks, if you borrow $50,000, and you pay that $50,000 back plus another $50,000, isn't that 100% interest? Oh, but no, this is 132,000. So that's another 50,000 to get it to 100,000. Isn't that 200% interest? And on top of the 100,000, there's another 30 grand. Isn't that 230% interest? You just took loans, rolled it into your 5% mortgage. And on top of that, the highest interest rate that you rolled into it was 30%. You just took all of that money and turned it into a 230% loan. Oh my goodness. And Taye says, wow. Ty says, wow. She says, wow. Folks, we didn't know this. This is what's going on. This is what we're being taught to do. Okay? We're being taught to do that. So we need to stop. We need to stop doing that. So listen, folks, I am so glad that you came in here today. We're gonna pick this up again on Friday, and we're going to talk about this some other issues, that how to set up your mortgage, how to set up your refinance, how to set these loans up to save you money and stop paying 230% on loans and you don't even realize that you're doing it. Oh my goodness, I am so worn out. So Tiana says, didn't know you could roll loans into your mortgage, but now I know to stay away from that. Oh yeah. Tiana says, whoa, Lord have mercy. All right. And listen, thank you so much, everybody. Thank you so much for being here. All right. So she says, amazing. Ty says, it's amazing as usual, Don. You always blow my mind with this stuff. Listen, I got more. I got a whole page of stuff of what to do and what not to do. And we didn't even cover half. All right. I got more stuff to do on Friday, but we're getting ready to come back on Sunday to talk about the biggest loophole you've ever heard of, and it's not even contained in the tax code. I'm going to show you how you can invest and make 100%, 200%, even 300% on your money and never pay taxes on it because it doesn't even appear in the tax code. It is the largest loophole you've ever seen or heard of. Be here Sunday to get that. But be back here on Friday to learn more about how to set up your loans. All right? Listen, folks, come on now. All right. I am so glad. I'm so glad you were here. So I'm going to let me go back to the room here. Let's see. Credit Goddess, are you still in the room to do an outro?
I am.
Would you please do an outro for us while I get a drink of water? Because listen, I'm just so excited. I don't know what to do.
Go ahead, Don. Go ahead. Hey, everybody. Happy hump day. Great room as usual. We are almost at the end of the year. We have about what, 3 more weeks? So let's end this with a bang. My name is Rose Laura Lewis, also known as Credit Goddess, all things credit, credit score improvement strategist, business credit coach, educator in the credit space, and also a NAV business loan broker. I do have a few announcements for you guys next Monday or this coming Monday.
Hey, okay, Credit Goddess, so that we
I'm here.
can, so that I can end on time. Can you? Why don't
Go
we
ahead.
hold the announcements till after we roll the
Okay.
credits, and then we'll come
Got you.
back and do your announcements. So, folks, Credit Goddess is going to give us some announcements. Hang out for just a few minutes. I'm going to say goodbye to everybody online. I want to thank you for being here, but I need you to listen. Do this. You got a lot of good information that you're not going to get anywhere else. Go to my link above and get your savings and earnings report. Go ahead and get it. You're not going to get this information anywhere else on the planet. So only at the P.I.L.L Method International. So get that information. Go ahead and do that and get my book. All right. Go to Amazon. Not only get my book for yourself, but get it as Christmas presents for family and friends. It's going to be a great addition to yours and their library. Thank you so very much. We're going to be right back here on Friday to continue with how to get the best loan options for yourself. And we're going to go over that again on Friday. Thank you very much, everybody. Our last words are going to be from Dr. Eric Thomas, E.T., the hip hop preacher. See ya.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.